Pardon our small technical difficulties, but I did want to take a minute to welcome you all. Thank you guys so much for coming out on this cold, cold winter night. I had a pastor on cold winter days who would say, it's only the brightest and best of you that found your way here today. So thank you. I applaud you, you brightest and best. But for you viewers at home, and I know there are many of you, you know what, you're in your pajamas all cuddled up and cozy, and that's pretty smart too. So however you join us, I'm glad you've joined us. Our heart is to bring you content that will educate, equip, and enrich your lives. Tonight we will have Andy Bruns, our senior investment strategist. He's coming to talk to us about investing in the Wealthquest Way. He serves on our investment committee, and Andy's graduated from Xavier University with his BSBA in finance and accounting, and has gained experience at a couple local investment firms before joining the Wealthquest team. He completed the Chartered Financial Analyst program and earned his CFA charter in 2015. Thank you very much, Andy. Welcome to the Wealthquest Learning Center.
Set up quick. And real quick. All right. So first, thanks to everyone for coming tonight. I'm honored that so many of you wanted to attend it either in person or online, especially when I believe James Linhoff is discussing vacation planning in the next month or two, which I think is probably a little bit more exciting. So as Joy said, I'm a member of with Wade and James Oliger. Together, we kind of visions of what goes into our investment portfolios, how we want our investments as a firm. For those of you at home, Sam Martinez is going to be handling technology tonight. So any questions that you have for me at the end, just shoot to him and he'll ask. Second, to do a little lighthouse. Keep me out of the doghouse. There's probably some things we need to do on the compliance front. So usual, any past performance that we discuss is not going to be future results. Also at points tonight, I guarantee you I will probably flip and not qualify a number. Just assume that I definitely did not say guaranteed for that number. Instead, I probably meant to say historical, projected, or expected. Also, I know I'm going to have some trouble standing still tonight, and this is more for the people at home. I believe that the camera might track me, but if it doesn't, feel free to give a shout out to Sam. Though if you do lose me on your screen, it's probably not the end of the world. So the plan for today is investments with you for about the first 30 to 40 minutes of tonight. And then we're going to leave ample time at the end to kind of let you guys have the board and ask any questions that you would have of us on the investment side. So today is meant, and so with that being said, today's meant to clarify, not confuse anyone. So at any point today, I do lose you, raise up a hand and we'll try to get you back on track, because if you're not progressing along with us, then you're not getting much out of this, which isn't the point of tonight. Also, if I'm not able to get to your question in the allotted time today, feel free, I'll stick around a little bit afterwards and we can chat. If not, I'll be throwing my contact information. We can schedule a time to a little more in depth after that. So since this is the first time doing this, we're going to keep it at level. College courses, we'd be doing investments 101, 102, and 201 tonight. The goal here is for you guys to leave with an understanding of what's in your portfolio. So we're planning on being very straightforward. I'm not going to try to throw too much data and numbers at you. Point, again, reach out. Contact information will be at the end, and I'm more than happy to sit and talk with you. Just content about it. And then since this is the first time we're doing this, and this is a final housekeeping of my purpose, any feedback you have tonight, Joy and I would love to hear it for future seminars. We want to make these things as informative and productive. So anything that you want to tell us. Also, if you guys read that newsletter, any sort of feedback and topics that you have on that or want addressed, feedback to me would be awesome on that as well. With all that being said, into the presentation. One of the things that we see with clients is that a lot of times their fears and investment anxiety kind of center around the fact in their portfolio. And in all fairness, it's also kind of been our mystique around the process. And so today we're going to try to shed some light on your portfolio and alleviate some of that anxiety. So it's our goal to continue to build trust in a partnership. Investment committee standpoint, one of the things that we love here at Wealthquest is having an engaged client base. So, yeah. The clicker's not working. Oh, there we go. So objectives today: demystifying portfolio, how we are going to be positioning for the market ahead. Finally, we're going to be answering what's on your mind. So demystifying the portfolio. Investments 101, the basics. And 103, the building blocks of portfolio management. So the basics. 201, sorry. So at the high level, these are the large buckets of assets in your portfolio. So we have stocks, bonds, and alternatives. When I was putting this presentation together, I was struggling with how high a level that we should start at in this. Initially, I thought, yeah, everyone, stock, waste of time. And then as I was reflecting on it, I thought, you know, I actually think that we've lost track a little bit of what stocks actually are. I mean, if you look at NBC, stock trading, to me, it's just this reminiscent of like the playground days when we used to trade baseball cards during recess. And, you know, all I cared about was I wanted Barry and Griffey Jr. I didn't care what I gave up for them. That's all I want. Just give me those cards until the next. I actually was reading some stats the other day. So back in 1940, the average holding time of a stock was 7 years. In the 90s, average time that a stock was held in a portfolio was 4 years. Reuters recently did a study on the average holding time of a stock last year. And does anyone want to take average stock was held in a portfolio? So 5 months, 5.5 months was the average holding time for a stock in a portfolio last year. So what does stock ownership mean? When you own a stock, you actually own a part of the company. You own a share of that company's value. A value because at Wealthquest, we think of stocks in terms of cash flows and in terms of values. When a company is able to generate free cash flows, they're able to return that value in 3 different ways to their shareholders. Dividends, which we are seeing less and less of these days. They're able to take that free cash flow and reinvest it into their company and grow their value that way. Or they're able to take that free cash flow and buy back their own shares, which raises the share price, essentially. It takes some out. So when a company buys back their own shares in a tax efficient way, you as a shareholder own more of the company. Now, what is their goal in their portfolio? Think stocks. Stocks are going to be the growth engine of your portfolio. That's where, when it comes to being your return, when it comes to outpacing inflation, stocks are going to be the tool that does it. Now, with that, obviously, you can't have return without risk. Nothing's free in this world. So stocks are also going to be the riskiest portion of your portfolio. Now, over 50% of the time, on a day-to-day basis, so one day, stocks are positive, meaning that the other amount of time, stocks are actually negative. So they do go down. Now, the neat things about stocks are the longer you're willing to hold on to it, the more likely you're going to have a positive outcome in stocks. So we look at the total US stock market since 1972. I know I told you I wasn't going to do stats, but I'm going to kind of lie. In any rolling 5-year period, 92% of the time, US stocks positive. If you go out to 10 years holding periods, 97% of the time, stocks were positive. At the holding period of one of stocks, or US stock market for 12 years, no matter when you buy it, you're going to have a 100% chance, historically, of having a positive outcome. Though at the end of the day, those stocks aren't riskless. I mean, we've seen it. Enron, that's the big bankruptcy. I'm thinking Lehman Brothers. Stocks do go bankrupt, and when they lose everything. So the stocks are bonds. And what are bonds? Bonds are the promise of a repayment of interest and principal to the investor. Your mortgage is a bond. Bank is the bondholder. You pay every month interest and principal back to the bank. Now in your investment portfolio, you're the bank. You're loaning out money to companies and governments on the promise that they're going to give you interest to compensate you for the risk that you're taking of trusting them with money, as well as the principal that you loan to them. Obviously, these are going to have less return than stocks. However, the role that they play in our portfolio, and I'm going to talk about our portfolio on this one, is safety. At Wealthquest, we tend to run a very high quality, safe bond portfolio with the intention of when we have those periods of market volatility, so think early 2020, that bond portion of your portfolio is protecting your assets from market decline. So when you need to withdraw cash, when we need to do some opportunistic rebalancing, we have bonds there to do it during these times of volatility. Now I'm making that distinction because there are firms out there that will use high yield bonds, which are fine. And we have them in our portfolio to a small extent. High yield bonds and stocks are really correlated. When stocks go down, high yield bonds go down. Another term for high yield bonds that you might have is junk bonds. So these are debt loaned to super risky companies that could have the chance of not repaying the debt. So you're getting a premium, but when volatility enters the picture, these bonds don't hold up. Now, these first two building blocks, stocks and bonds, are going to be in about every investment portfolio that you would ever go to. The more stocks you're going to have in the portfolio. Is if you have a big return objective, you're going to want more stocks in your portfolio. If you want less risk, as well as be able to take less return, you're going to have more bonds in your portfolio. One of the things our advisors for wealth is, when you first come aboard, you meet, you talk, we discuss your risk tolerances, taking into account your age, and we do our retirement plans for you and say, hey, to meet your retirement goals or your goals in retirement, this is kind of the return that we need to target. That might be the advisor to say, hey, your risk tolerance would be a 60% bonds or 60% stocks, 40% bonds, and we need to 70, 30, 80, 20. You're going to have to take on a little bit more risk, a little bit more stocks in your portfolio to hit that objective. Likewise, depending on your financial situation and age, you might be a super risky client. You might, I'll take stocks all day long. And we might say, hey, you kind of made it. You don't have to take risk. It's okay to take some off the table and put it into these safer investments. But ultimately, we're here to guide you into a portfolio that you can hold on through all market cycles. Our collective experience at Wealthquest, across our advisors, our investment committee, tells us that the best portfolio that we can put our clients in is a portfolio that you can hold and withstand through all market cycles. If 2020 happens and you're calling to sell out, that's not going to be an outcome for you because you're going to miss the subsequent rally. So staying invested in the whole time and being in a portfolio of stocks and bonds you can stay in is for you. Final bucket that we're going to talk about in basics is alternatives. Alternatives has kind of been a catch-all phrase in the industry. This is pretty much anything that doesn't fit neatly in that stock and bond bucket. So this can be gold, real estate, commodities, managed futures, options, possibilities. But this is say, hey, we're either going to put this in your portfolio or enhance your return. At Wealthquest, we handle it a little differently. We're going to talk about these in depth later on in the presentation, so we're just going to touch on now. We use a product called buffer notes in our alternatives bucket, and to like the outcome that they give. At the high level, these notes are structured to kind of tilt the plane in our advantage to meet a return objective for our client. Is across all market cycles, they consistently perform. What you see a lot, what we see a lot in other alternatives, let's take commodities, for example. You'll have a really long period of underperformance or lagging the past 5-6 years. Commodities have kind of been ho-hum. They've been there, they haven't done much in your portfolio. Might have kept up with inflation, might have exceeded it. Now, if you had commodities in your portfolio towards the end of 2020, 2021, you are looking like a genius. I mean, they blew it out of the water the last yearish. Being said, we would rather have something that performs consistently in your portfolio than something that underperforms for a long period of time. Brief, hey, we did that. We had, let's ignore the past 8 years that didn't do anything. So that's the basics. And the next time we'll go to, I think this is 102 here. The tools in portfolio management. So before we get to the tools used in portfolio management, we do need to segue and talk about market efficiency. Market efficiency is a core tenet of our investment philosophy and our core beliefs. And the best way that I can talk about market efficiency is kind of a real life experience. It's kind of how I, 4 years ago. So I came out of college in 2009, which was a great year to come out with a finance degree and looking for a job in investments because everything was going great. There were a ton of jobs, nothing was happening in the market. It was a perfect time to graduate. Being said, since my time in the market, so 09, the typical day of, if you look at the S&P 500, which is just a large cap index, and we're going to use that as a reference a lot tonight. So what that is, it's the 500 largest stocks in the US. The average daily movement of that index is less than 1%. You don't usually see big swings. Days are boring. Now you do see big swings and they make the news. CNBC will throw a breaking news red flasher across the thing and tell you it's the 4th day in a row that stocks have been down and everything else. But typically less than 1%. So I was doing this article on market volatility. So I pulled all this data on S&P 500, looked at, opening price, closing price, intraday's highs and lows. Going down, I started recent, was going down the list. And all of a sudden in the 70s, like it was insane. It was just like I was looking at it and kind of average market swing intraday for the S&P was over 2%. I was like, man, what's happening here? And so everything else I started in 1982, S&P 500 futures started trading. So all of a sudden traders had information on what they think the market's going to open up for the next day. And then farther on, when you get to 93, well, electronic trading took over. And all of a sudden stocks were traded 24 hours a day. And so, you open up your Bloomberg terminal, do your work, and you kind of knew what the market was going to open up at. So there weren't these big surprises and people were processing all this information in such a short amount of time. And so it kind of just leads into, as we keep getting more and more technology and as information and data keep on being more available to everyone, the market keeps getting more efficient. It's harder to make money by picking stocks and being an active manager. So, and it's insane the quantity of information out there. I mean, just prepping for this, I think everyone's familiar with Apple. If you were to take an Uber tomorrow and talk to your driver and say, hey, thinking about putting some money in, I would probably bet you that they're going to, Apple, I hear, is probably a good place to put your money. And I was like, man, I wonder how many people actually cover Apple. So if you go to the Wall Street Journal, they have 44 analysts that is covering Apple. Just the published analysts that they do. Then every bank company in the large cap also probably has an analyst that covers Apple. There's 1,100 active funds that are publicly traded in the large cap space. I think if we can account for, there's probably companies have 4 or 5, 6 funds, some have one. I would say you probably have another 250 professional analysts that cover Apple. And then you're looking at, well, there's international funds, private funds, and there's individual investors. There's so many eyes on Apple anymore. And I'm not saying you can't make money betting for or against Apple, but the chance that Apple is going to surprise on earnings and the market's going to be shocked that, they guidance way up. Well, guidance is actually usually where the hit is, but that earnings, hit or miss, everyone kind of knows what happens. So it's just hard to make money in those spaces. And before we get into the tools, the last segue I'm going to do is one of the things that I think Wealthquest does a great job of doing different than a lot of other shops. And it was actually one of the reasons that drew me to Wealthquest is we are able to pick the right tool for the job. We're not pigeoned into we're a certain kind of shop. We're not like an active management shop where we believe in active management. Active management is going to outperform. Active managers is the only way to beat the index and earn our clients money. We're also not a stock shop. We're not saying, hey, we pick stocks better than the index and that's how we're going to give our clients money. And we're not an index shop where we'll just give our clients what the market performs, hopefully, and we'll be good from there. Instead, we're using the right tool to efficiently allocate our capital across all these market instruments. A little side tangent is that, and due to the variety of instruments that we use, our average expense ratio for our portfolio is about 30 basis points. So that's 0.3%. The average is 50 to 60 bips. So we're about half the industry on actually managing money or the expenses that we pay to managers. So let's get into the tool actually use. Passive. So when we use a passive, we think that the market is efficient. That is not impossible because some managers do it. They're very hard to find and they're very hard to find to consistently do it. But we think that the market is so efficient, it's hard for managers to actually outperform their index. Large cap core, US large cap. We talked about the S&P 500. If you actually look at that data over the past 5-year period, the S&P 500 has beat 85% of all active managers in the space. 15% of managers in the last 5 years have beat the S&P 500. Annually, when you look at performance, it beats about 5% of managers. So to be able to go in and say, all right, active management, we can find a manager that can perform it is pretty hard to do. We use Vanguard Large Cap Index, VV in this space, costs you 3 basis points, right? 3 basis points, 3 basis points. So 0.03%. This also kind of helps us avoid return chasing. This is what I found out a lot of times when I worked at active investment in my career. A lot of times you'll be doing a screen and saying, oh, this guy is 100, we're going to invest in this guy. And then what you find out is it took a lot of risk to do it. And at some point that's performing. And you go, oh man, this guy's not beating it anymore. Let's find this guy that's beating it. And you start this cycle of trying to chase returns and trying to find that guy to consistently do it. And you tend to end up putting yourself behind the 8 ball consistently when you do it that way. So passive also is going to be the cheapest tool that we have in our tool belt. The next one is semi-passive or factor-based. In your portfolios here, that's represented by DFA funds. So what semi-passive or factor does is this is where the market is mostly efficient. But there is opportunity to beat the index by a quantitative approach. So what a manager's doing here is they say, hey, Here are some factors that we know. So for DFA, it's stocks. They buy smaller capitalization stocks, and then they buy stocks that are profitable. And they say over long periods of time, if we can invest in these factors and tilt this index in these ways, outperform. And they have a fairly consistent track record of doing so. Once again, you do need long periods of time. It is quantitative, but with that, and since it's not a guy, you're not having this huge analyst team research and stuff, it is cheaper. So this is kind of a mid-range option in our portfolio. Provide some alpha. It can beat the index over long times. A little bit, does a little bit more than passive, but not quite as much as active. Last tool in our tool belt, active management. So this is traditional portfolio management. These are the names that you see in your portfolio: JP Morgan Equity Income, MFS, SBA, Thornburg, are all the active managers that we use in our portfolio. To get to this, we have to believe that the market, the space that we're trying to capture, is fairly inefficient, and that we can find an active manager that can exploit these inefficiencies consistently, provide excess durable returns for our clients over time. The biggest knock on active management is the expense ratio. And this is where a lot of the old passive shops are. They'll say, hey, we run a super cheap portfolio. This guy is paying some 1% to run his money. We factor that in, but at the same time, the expense ratio, so this is the management fee that the manager charges to the manager. So they're trying to beat, let's just say, large cap. Not that we would use active management in large cap core, but let's just use it for example. So let's say that the index return and the active manager that we picked had a 1% management fee on top of that. That means that for that year to beat the index, manager has to outperform, or at least produce a return of 21% or greater in his fund. So higher that the manager puts his expense ratio is the higher the hurdle that he has to clear. Over time, what we've been seeing is a lot of these fees have been compressing as it's been getting harder and harder and the market keeps getting efficient. There are spaces where you will see some pretty substantial fees that will get knocked. Also spaces that you a lot of micro caps, small caps, emerging market small caps. These pretty niche areas of the market have these high management fees. So the last bit that we're going to talk about are the building blocks in the portfolio. And this is where what we do as an investment committee to play in managing your portfolios. This is taking the tools, taking the basics, put them all. First up is asset class allocation. So we discussed the building blocks and the basics: stocks, bonds, derivatives. Under each of those layers are more layers. And then under each of those layers are more layers. That second level. So what we're talking about, so for you, we're talking about large cap and small cap stocks. We're also talking about US stocks and international stocks. And then in international stocks, we're even talking about, well, do we want developed markets? So think Europe, Japan, or do we want emerging markets, which think China, India, South Korea, countries like that. And then under bonds, so while stocks get the majority of the attention, I think if you were to ask Wade or James, the bond market is a lot more complex than the stock market, and you can slice and dice the sub thing so your heart's content. And we are, and at any point you want to. So what we do with asset class allocation. So as an investment committee, the week, constantly, I would say James and I, well, we've been trying to distance a little bit more, but we're at least talking 2 or 3 times a day just on our portfolios and how we're positioned. What we do here is we take a top-down approach on asset allocation. So this is your Boeing 747 view of the investment world. And what we're saying is, hey, where are we seeing risk in the market? So, and with that, we are going to kind of segue a little bit. This, so another will fit in. Capture a viewpoint in the market. We'll throw in a passive investment just to say, hey, we want exposure and we know this is kind of like a fleeting opportunity. So we're just going to buy that exposure. Short-term bonds is a great example. So in your portfolio, you hold a little ETF called SHY, which is the iShares 1 to 3 short-term treasury bond if you cared. So what we, in 2020, initiated that position because we had a viewpoint of, hey, we think that valuations are getting a little steep. There's these COVID concerns happening, and we kind of wanted to shore up our bond portfolio, quality tilt. So we moved a higher yielding, lesser credit quality out and put SHY in. Just last week, we actually then used SHY, the trading piece, to express another viewpoint. We had started seeing move along the yield curve, so high or longer term rates started to move up. Hey, this is a great time. Take a little bit of SHY out and put it into our intermediate term bond portfolio. Next building portfolio is manager due diligence. And this ultimately comes down to picking the right tool out of that tool belt that we just discussed. Best way that we can talk about this is, I believe it was another summer of 2020 trade. We were looking at emerging market space. DFA emerging markets was our only exposure in that space. So once again, that was those semi-passive factor-based things. It had been out of favor for a while. This year, that investment thesis actually finally paid off, and it had really good outperformance. But we were saying, hey, you know, this thing has been lagging. We kind of need to countermine. So we started saying, hey, we need to do a search. So the first step we do is say, hey, all right, emerging markets. Is the market efficient? Is the market inefficient? Or do we think we can find an active manager in this space? So we thought about emerging markets. Not only do you have picking the right stocks, picking the right companies, picking the right sector allocations like you would in the US, but then you also all of a sudden have, well, what countries can a manager allocate to? What currencies can they be exposed to? So there's just a lot of ways that the managers in emerging markets can be different from their benchmark and provide excess return. So we said, yeah, market's inefficient. Let's definitely do, you know, active manager search or semi-passive search, whichever comes up. So we started our screen. So our screening process for emerging markets started with 600 active funds, or 600 funds, active and passive are in this mix, as well as about 100 ETFs. So obviously we're not reading. So a statistical screen that we run through. Part of this is performance, but then part of it's statistical numbers like Sharpe ratio, tracking error, information ratios, upside downside capture, batting averages. And through this screen, we can usually narrow down that 700 name list to about 5 to 10 names. And from there, that's when kind of the stars, at least are kind of fun, of starting to do these manager calls. And what's kind of cool about this, as Wealthquest has grown, we keep getting more and more access to managers as we've become bigger. So when we can usually get direct access to these managers, which is awesome, instead of having to go through, you know, a middleman or a seller. So we start doing these managers. We set up calls and we start the qualitative approach because we've already done their performance. And what we want to know in these calls is, hey, you know, what's your team look like? We're going to do emerging markets, international. Like, do you actually have analysts in the countries? Are they speaking the language? Like, what's kind of your research base here? How do you choose what to go in and out of the portfolio? And more importantly, like, yeah, okay, this is how a name gets in the portfolio. How do you decide when to sell? Like, what's that risk management process? So, you know, and I think, so one of the reasons I like using this example from an investment community, this was a solid discussion and decision on our our end. So I think if you ask any of us, we were pretty, I think the consensus was that we were okay taking DFA out of the portfolio and with a couple new names completely. We ended up keeping DFA in the portfolio because our name, which was JP Morgan Emerging Markets, when you pair those two names up, they just work well together. So when one zigs, the other should. We've been seeing in some of our investment thesis. So pick JP Morgan equity markets, figure out the allocation, but it's still not because when a name makes it into our portfolio, we then go in and write a buy thesis, which is kind of the document that we circle back to every semi-annual call that we have with the manager. Because from there, we're saying, all right, this is the reason we bought JP Morgan Emerging Equity. If the manager do what they're going to do, if they missed, did we expect this miss? Like, are they missing for the right reasons, or are they missing because all of a sudden, I know we said we're emerging market mandate, but really found this name in Germany that we like, and that's what we put in the portfolio. We're also tracking, has the team changed? Are marketing styles, which I've seen in my career. For sure, I've had a value manager that became a growth manager in my life, which was interesting. And so from there, it goes into our portfolio. And if we're doing our jobs right, we would tell you we would love to pick a name and really get out of it, because that means we found a manager that's able to provide consistent excess returns for our client across all market cycles. I believe 2 of our bond funds have been in our portfolio since the inception of our firm. So that's 15 years now or so. Block is alternative. And these are the buffer notes that we talked about, which is what we'll discuss here. Now, I'm not going to get into the details of exactly how these work because I've kept everyone awake so far, and I don't want to lose you. I start talking about writing in and out of the money call options. Do with buffer notes is investment banks, Goldman Sachs, Barclays, Toronto Dominion. We look at the opportunities in the market and we say, hey, these are the terms we're looking for to write these custom notes for our clients. And the basics of that conversation is, you write one of these notes, the bank is saying that at the end of the term of the note, so in 2, 3, 5 years, they are going to pay out a certain amount based on the performance of the underlying asset, which is the S&P 500. In most cases for us. So again, we want to reiterate with this alternative bucket is it's not supposed to act like your stocks, and it's not supposed to act like your bonds. This alternative bucket is designed to give our clients a high probability of meeting a return objective. We try for 85 to 90% chance of hitting a targeted return with these notes. And we typically write 2 types of notes. There's a conservative note, which are return 4 to 6%. There's more aggressive notes, which tend to be 8 to 10%. The amount of notes you have in each portfolio is kind of designed on your stock bond ratio. So if you're conservative, you're going to have more conservative notes. If you're a more aggressive client, we're going to put more notes in your portfolio. What's been awesome about these notes is we've had a really good historical track record of hitting our cap numbers with these. So that 90% has been 1 or 2, which we've actually added alpha on in a different way. But we're going to get into this with our forecast. But if the market is going to be like we think it is over the next decade with muted returns, chances where some of the leverage features of these notes are going to come into play and add some alpha to our portfolios. Bit of housekeeping on building blocks is rebalancing. And this kind of goes with our last core investment belief. We believe in mean reversion. If something's outperformed, it's eventually going to underperform. And if something's underperformed, it's eventually going to outperform. So with rebalancing, what we're doing is we're taking the winners, harvesting the gains, and reinvesting them back into our losers. Now, this could be growth did well, value didn't, so we're harvesting from growth, putting into value. This could be stocks did well, bonds didn't, or vice versa. If we were rebalancing in March 2020, we would have been bonds buying equities. The other big key about rebalancing is it keeps our clients' risk tolerance in line. Let's say you came in as a 70-30 portfolio 5 years ago. We've had in equities, if we didn't do any rebalancing, all of a sudden you might be opening your portfolio and you would probably be an 80-20, 85-15 portfolio. So all of a sudden you're taking on a lot more risk than you intended 5 years ago when you signed up with us. Now, positioning for the road ahead. So this gets into forecasting, which I won't speak for Wade or James, but is my least favorite part of this. Because what it gets into is I love forecasting. I love playing this game. So don't get me wrong on that. What I hate about forecasting is it gets into this short-term thinking. And short-term thinking, if you haven't picked up on it, I am not a crazy big fan of CNBC. But short-term thinking is what these media and these market experts really get into. What makes the news, what makes headlines, it's what makes you open the Wall Street Journal every day. And it's like, what they want to do is they want to hype this fear of, hey, this idea is going to take off and you're missing this. Or this, it's a big one. I don't know why your portfolio is not positioned for this, but it should be. We like to think in longer term investments. Our goal here is to get you working age to retirement, in retirement, through your retirement. Like that's our goal, is not to try to sell a headline. But this is also forecasting, as we touched with our 747 view, is a place that we have had decent success adding alpha for our client portfolios by nipping around the edges. Our core portfolio, we want to be this all-weather. We don't really want to make a lot of changes to it. It should perform across all market cycles. What our forecast does is it kind of lets us nibble around the edges to add excess returns. This might be adding a little bit to international, adding a little bit more bonds. It also lets relative opportunities. So March 2020 was happening. The world was collapsing. We were rushing to buy toilet paper. We were actually selling some of the bond portfolio to move into our alternatives bucket. So during March 2020, we had written a note, locked in a decent gain. And if you couldn't get the note, we put you into another aggressive alternatives. We were actually taking risk to our portfolio, market giving it to them. So with that being said, headwinds coming up to the next year. Complications from COVID-19 variants, supply chain and labor disruptions, inflation and interest rates. And those first two could really just boil down into last bit. So the rising inflation and interest rates. The market seems like it has a lot of concerns weighing heavy on it right now. And I'm going to spend a quick thing debunking that because we think that we're going to see some modest growth next year. So this is where stats are coming in charts. So I apologize. Let me get it. So inflation. Over the next year or two with inflation, we think that this is going to be an area where we're actually going to excel. We have had a quality focus when picking names over the past few years. And that quality focus has led our managers to focus a lot on this bottom line of free cash flow. So we initially discussed free cash flows are cash available to shareholders that a company could use to grow its investments. Companies that can protect their free cash flow next year are going to be able to weather the storm better than companies that can't. Now, a lot of these companies with inflation comes to revenue and expenses. Those top two lines are what's going to be hit by inflation. For the big thing, right? All of a sudden, labor costs are going to go up, your input costs are going to go up. That's your steel, that's your electricity, that's your utilities. Companies that control these are going to do better, as well as companies that have pricing power to pop that top line revenue number up. So our active managers have quality focus on free cash flow. We think that they should be able to have a pretty decent year coming up. The next bit that we're going to talk about is in rising rates. Let's see where I have that chart. So just because the Fed is going to hike rates doesn't mean that the market is going to go down. These are the last 5 rate hike cycles by the Fed. 94 to 95, 97 to 98, positive, positive. 99 to 2001. I wasn't in the market at that point, but I am gonna guess, just go out on a limb and saying, I don't think that the Fed raising rates had anything to do with the market being down during that period. I believe there might have been some sort of bubble that's happening, maybe around internet and tech stocks. Then, this is a favored time period here. 2004 to 2007, we had 16 rate hikes by the Fed. We went from 1% to 5.25% on the Fed funds rate. Market did mid to high single digit returns. The big thing that the Fed can do, the Fed, what they're doing, we're going to some shocks. And we're going to be in for some shock strain. That's what the market does. Market gets scared, market sells off. Fed telegraphs, Fed is transparent. We would expect anywhere from 2 to 4 hikes this year, probably in the 2 to 3 range. We think Fed hiking is not going to impact on stocks this year. Straw that breaks the camel's back. 08 to 19 too. I mean, that's the same time period. And then tailwinds that we're in, even though the Fed's high, we still have historically low rates, and we still have a lot of companies with great balance sheets and cash on their books. We also have relatively strong consumer demand. We wrote about it. I don't know if you read the monthly, we mentioned it in there. What we have been seeing a lot of is loans go up, which is a good sign of a confident consumer, right? You're not borrowing when you think that the market, like job's going to go away. We've seen people sitting down there safe, also a good sign of a strong consumer demand. And I am trying to think of the last signal, and it is escaping me, so I apologize. And again, we're seeing continued. Events are, I believe, to around % earnings growth this year. So that's some weight on it, but it's nothing that the market can't navigate as long as rational heads prevail. Overall portfolio positioning, we're still favoring large cap stocks and small cap stocks. For emerging markets, US over international, sorry, first off. Large cap US over small cap US. In the international space, for EM overdeveloped, just on relative growth opportunities. And as we mentioned, we do have a quality bias in our active managers, first growth at all costs. Bond side, we still favor short-term over intermediate, even though the hiking short-term should reset a lot. That is something we're actually monitoring as we just, but we're still slightly underweight intermediate term from our neutral stance. Quality over high yield, because we still want protection. And investment grade over government, so we're willing to take a little credit risk, but not a ton. And that is that. So we'll open it up to questions. Okay.
I'm just curious, when I see
Uh,
I go in and I make documents. American, I see all these trees in different places. And I never get a reason for
so there are two things that are probably going on there.
why can't you? What's going on?
Because I would have to pull up your portfolio and look at it. The two things that are going on. So one is just periodic rebalancing. So as we discussed, what's probably going on in your portfolio as we have over the past year on the investment side, we've been a technology. So we're trying to run our cash a lot tighter. So a lot of those trades, James, you can correct me if I'm wrong, are probably coming from this invest cash thing. So every morning what we're doing is we're going in looking to see if there's cash available into a portfolio to invest and then investing it. So we're buying if we can buy because we're trying to keep that cash pretty tight because cash is not earning much these days. Yeah.
When there is a lot of activity.
Yeah. Okay. Yeah. 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 It's just capital distributions during that time. So in that time period, mutual funds are throwing off gains and our cash invest is just going in and saying, hey, this is cash, let's invest it to the allocation. But yeah, we can look at trying to figure out some sort of communication on that. Yeah. Yep, so that's part of it. Yes, sorry, train me. So the question was, does Wealthquest do any loss harvesting portfolios? So we do as part of our rebalancing activities. We did a decent amount in 2020. 2021, the market really didn't have a lot of opportunity to harvest some losses other than some of our bond funds. And one of the things that we don't do, and it's kind of a courtesy thing on the side, we don't like churning our active funds. It's for the manager, they're having to deal with the flow on their end too. And it's kind of giving all the clients a bad experience in that. If we're all of a sudden withdrawing, 20, 30 million out of fund and putting it back in 3 months. So any for sure, like investment ETFs, any name that we are maybe looking to get out of and change, we are looking at loss harvesting if it's there. The reality is we've been in a heck of a bull market. Opportunity. Yeah, we don't do stocks. It's not our bread feed thing. Rather choose in the areas that we think that they can stock pick than do it ourselves. I mean, that's just a whole research. I mean, we could. I'm not going to try to. A lot of times when you go to a shop, what it kind of turns out to be is a base. So they're just kind of taking an index, putting some quantitative factors and tilts around it and saying, that's your stock portfolio. We'll just buy the passive exposure, being down 2% or up 2% in a given year. We'd rather just give you that large cap exposure. Oh. Okay. Yeah, that's a good. It is actually feedback. So maybe what we'll do, especially for these big model changes, we'll send out a note to our advisors. Did I repeat the question? It was a comment. Yep. It does. The question was kind of the names that you're seeing in the news, what's really driving the performance of them? Is that the great? Yeah. So I'm going to caveat. So Kathy has actually ARC has had not a great last 3 months. I think they're down 40-50%. And so that's kind of what we were talking about with active management earlier in these efficiency. So, and I think there's two things. One, it catches a headline, right? So when so Kathy looked at ARC investments, and what ARC did was they were a really high-tech, innovative growth portfolio. She hit Tesla, she hit a few other big names, if I can remember right. And I'm going to be very vague. Exactly what's in her portfolio. But a lot of times it's kind of a self-fulfilling prophecy, right? You start being the star manager, you start picking the star, and then you get media attention. And he's like, you look at Peloton is now like below their IPO price, and they were like darling of 2020. So there is, but it goes back to once again that management thing that is the market is efficient overall. A lot of times, and what Kathy did is she pushed her risk profile up. Like her name would be something that I would say would probably never make it into our portfolio, other than, if we had a very small conviction of a very small percentage of the portfolio. Could say, all right, if we really believe in growth at all costs, we'll throw a 2% allocation in it. That's what we do. In names like those, it's stuff if you want to play and hit on it, that's great. But a lot of times what we see are those managers are like Mark would probably be a 1,000 growth, and she was pushing risk in her concentration really high in that portfolio. So she was hitting these names and hitting these concentrations really well. Out when you could, you would have killed it on that fund. But if you're in it for the ride, you're also down for this 50% extra risk, and she's hitting this period of underperformance. And if there, but it's to stick with the manager like that. Yeah, it's risk, it's belief. And it's the reason any active manager can outperform is they have a belief or a factor of no, they're holding things that market doesn't. Yep. So yeah, you'll see the buffer note appear in your broker account. So these are held within your custody app. So what you'll see that we have these holding bank funds. You'll see them as innovator ETFs. So they track really similar to the custom ones we do. But as we're doing rebalancing and allocating, this is just a way to say, hey, we can get similar exposure until we're ready to see some market conditions that let us write a custom buffer note. Some innovator buffered notes, and we just did a conservative note 2-3 weeks ago, where we sold middle of December, where we sold one of the innovators, innovator in portfolio, and then purchased the buffered note. So you would have seen a sell of the ETF and then a purchase of the note in your portfolio. I did not repeat the question again. I'm sorry, Sam. Or you guys saying that? Okay. Ooh, what is an ETF? So the questions were, what is an ETF and active versus passive? So once again, passive is just buying the index. So it's buying the S&P 500. You're going to get the S&P 500's return. Active is manager that does fundamental research and actively manages his portfolio. Not the word in the definition. I think a third grade teacher would smack me right now. They're constantly buying and selling stocks in a portfolio to outperform the market. So that's fundamental bottom-up research. That's picking names as they go along. Is that sufficient? I know that person can't answer, unfortunately. ETFs are basic version. They trade like a stock. They act like most of the ETFs that we use. Nope, we're going to keep this simple. If that person has more questions on ETFs or anyone else does, we could talk about them. Active ETFs now. A lot of the ETFs are passive investments. We just like them because they're easier to trade in and out. We can trade them more times. So, you know, if we buy it at 9:30, it's in the portfolio at 9:30:01 instead of having to wait till the end of the day to trade. It's just a more efficient trading vehicle. And we can also tax loss harvest a lot easier out since we can just buy the day. It's stocks is what an ETF is. That trades like a stock. A lot of times it tracks an index. That is a good question. Oh, to answer it, maybe a little interactive example. Huh? Oh, first rodeo. So, as around inflation. So, what's going to be transitory inflation and what inflation might be a little stickier? So, we do think we're going to this year. It's going to keep going. Kind of the easiest way to explain what's going on with inflation, what might be transitory and what might be a little stickier, is an example. So, do we have Bengals fans in the room? Not a ton. All right. So let's say I had like 10 Bengals tickets to this week's game, right? This weekend's game. And I said, all right, so what would we say, like $200 would be a fair price? Call them decent tickets, probably a little cheap, what I just saw on Ticketmaster. But let's say $200. If anyone wanted a ticket, 10 tickets, $200, would we do them? Yeah, no, yes, great. So last year we had this influx where all of a sudden now I have 5 Bengals tickets instead of 10 Bengals tickets. So maybe be willing to pay $300-400 now for that ticket. If the demand, so right. So you're willing to pay a little more for a good that's not there. Now, they when walked into that door, gave each you $500. Now all of a sudden we have those tickets. You have 500 extra bucks in your pocket. Would you now be willing to spend $600-700 on those tickets? Right? We just gave you a free 500. It's not costing you anything. So the demand and supply is increasing, which is what we kind of saw last year. People came out of the pandemic, for the most part, in a better financial situation than when they came into the pandemic. And people had this roaring demand for goods. Like we were stuck, we couldn't buy anything, we couldn't travel for so long, we got out of it, game on. At the same time, so tightened, right? We're gonna get those goods, gonna get those services. And so we got this perfect storm of low supply, high demand. As supply chains get back on track, that part should be transitory. You're gonna start seeing goods in stores again. You're not gonna have to pay out the nose for them. Oil companies had idle rigs, right? They weren't producing oil because there was no demand for it. I believe that you are willing to accept physical delivery of oil. That's not the case now. They idled rigs because they couldn't sell it. They had to literally give it away. And so they idled rigs, laid off workers. As the workers come back online, all of a sudden that supply catches up to the demand. And you start seeing those prices dip down. And so all that stuff will be transitory to an extent. Some prices will stick around. If a company pushes through a price increase, they're probably going to be a little hesitant to take it back, as long as people are willing to pay the price. Where things might get sticky is if all of a sudden we start seeing some wage inflation. So if all of a sudden we start seeing wages go up, all of a sudden the amount of money in the system keeps going up, and this is where the Fed is going to kind of step in, and this is where rates come in a bit, is all of a sudden more money in the system, even though supply is up. Well, you can still charge a decent amount of money for that good because that money's not there. And so that's where inflation could get a little stickier. And that's kind of we're in this wait and see pattern on what happens with wages as the data comes out. Is it? Yep. I am willing to take a stab at it because I am always a little intrigued. I think the technology will exist. Technology, I think, is fascinating. But so I do think crypto will probably have a role. It's just which one makes it, maybe. Or if of a reserve system. Sorry. Question was, will crypto and NFTs exist in 10 years? And there is a chance that the Federal Reserve comes in with crypto. What's great about that is the blockchain technology can actually be applied to a ton of areas. I think where we've talked about it, and we'll see companies are working on it, is even stock settlement. It's in our industry. All of a sudden that, each stock certificate has a unique identifier flipped to it. So when I buy it, it gets flipped to me. I add my little bit that says, hey, it's been in my portfolio. And then when I sell it, it can just go over to James's portfolio. I have to track all these, what shares have been loaned. It can make settlements a lot quicker, almost real time. But the blockchain technology has value. Crypto, I don't invest personally. It's one of those things that if you have an interest in it, we don't encourage small bets, but if you want to, a small bet can never kill your portfolio if you do it on your own. It's one of the believe in it and enjoy it. Put it in your portfolio. It might go out. It might go to nothing. Just always be prepared for stuff like that to go down to nothing. All right, Joy, do you want to close us out? Thank you.
Andy, you are so smart. Thank you so very much. When I was a kid, we used to play that game of life, the classic board game, I think Parker Brothers, and you're trying to get your little card to the retirement square without going bankrupt. And I think they had stocks and bonds in that game. And my kids have a version of it now that's more modern, and there's none of that. So um, life has gotten a lot more complicated. I'm so grateful, Andy, for you and your team in simplifying it and explaining things to us and educating us. Thank you. Thank you all for coming. Thank you at home for viewing. And please consider coming for our next seminar, February 17th. It's called Preparing for Long-Term Care and Its Costs, How to Retire Stronger. And we will have guest speakers from Issue Insurance to give us that seminar. So thank you. Drive home safe. Have a great evening. We'll see you next time.